If you're a contractor doing 3 million, 5 million, or even 10 million in revenue and you feel broke at the end of each year, you don't have a revenue problem, you have a profit definition problem. Today, I'm going to show you why most contractors are using the wrong profit number, how it's quietly destroying their business, and how to get around this. So let's get started. If you're new to the channel, welcome. My name is George. We talk all things accounting for contractors here. So in my accounting practice, we work exclusively with construction contractors. And one of the biggest problems I see isn't a lack of work. It's misunderstanding profit. Most contractors say I made good money this year. But when I ask, was that gross profit, operating profit, net profit, or contribution margin? I'll get a blank stare. Before we dive deeper, if you're a contractor doing over 1 million in revenue and you want clarity on where your profit is actually leaking, book a call with us. Our calendar link is down in the show notes. We only onboard a few contractor clients per month due to capacity. So let's start from the top. Revenue is your top line. Revenue minus costs equals profit. Sounds simple, right? Well, the thing is, it's not even close. On your income statement, there's multiple types of profit: gross profit, operating profit, net profit, contribution margin. Each one tells a different story. So let's talk about gross profit first. Gross profit equals revenue minus cost of goods sold. For contractors, cost of goods sold typically includes direct labor, materials, subcontractors, equipment directly tied to jobs. Gross profit tells you if your jobs are priced correctly. If your gross profit is weak, no amount of cutting overhead will save you. For example, you're running 18% gross margin when your market requires 30%. You can slash office expenses all day, but you'd still be bleeding. So here's where contractors can get deceived. Some companies move expenses around. They shift costs between cost of goods sold and overhead, and suddenly they think gross profit improved, when in reality, nothing actually changed. This is why understanding the structure of your income statement matters. If your gross profit is declining, you need to ask, are labor costs rising? Are we underbidding? Are we discounting? Are change orders slipping through? Gross profit tells you if your jobs work, but it does not tell you if your company works. Which brings us to our next point, operating profit. Is the business healthy? Operating profit equals gross profit minus operating expenses. Operating expenses include office payroll, rent, insurance, admin staff, sales and estimating, depreciation. This is also called your EBIT. This is the profit your business earns from operations. It removes interest and taxes because those depend on financing structure, not operating performance. If your operating profit is weak, you don't have a tax problem. You don't have a bank problem, you have a business model problem. If your operating profit is under 10% as a contractor, we should talk. Most of our clients operate significantly higher once they're structured correctly. So again, our calendar link is down in the show notes. So next, let's move on to net profit, the bottom line reality. Net profit is what's left after cost of goods sold, operating expenses, interest, taxes, one-time charges. This is the real bottom line. This is what lenders, investors, and buyers care about. This is what can help determine business valuation, bonding capacity, bank leverage. But here's the problem. Net profit can be manipulated by timing expenses, moving costs, aggressive depreciation, one-time adjustments. We've seen contractors inflate earnings to hit bonus targets. Short-term thinking destroys long-term business. Healthy construction businesses will manage for operating strength, not cosmetic net profit. So let's talk about contribution margin, the hidden weapon. Contribution margin equals revenue minus variable costs. This is critical for contractors deciding if they should add another crew, drop a service line, expand geographically. Contribution margin shows how each additional dollar of revenue contributes towards their overhead and profit. If your contribution margin is positive, then volume will help. If it's negative, then more work will make you worse off. I've seen very large contractors go bankrupt because they scaled negative work. So this one's an important one. Scaling revenue without a contribution margin analysis is financial suicide. So to bring this all home, what does this mean for contractors? Here's the hierarchy. Gross profit. Are your jobs profitable? Operating profit means, is your business structured correctly? Net profit. Are you actually making money? And contribution margin. Should you scale? Most contractors only look at revenue. Sophisticated contractors understand the profit layers. The difference is millions over a career and being able to scale successfully or not. So just recently, we worked with a contractor doing just over 4 million in revenue, and they thought they were profitable, but after restructuring the financials, true gross margin was like 6% lower than reported. Contribution margins were negative on 2 service lines, and overhead was bloated relative to volume. So within 12 months, gross margin improved 8%, operating margin doubled, and owner's pay increased significantly. So they didn't need more jobs in this case. They needed better clarity. So if you're serious about building a contractor business that produces real profit, increases enterprise value, or supports your family long-term, then we should talk. And again, we only onboard a few contractor clients each month. We're not a volume shop. We try to give good quality attention to each client. So our calendar link is down in the show notes. Hope you found this helpful and see you in the next one.